Hey guys, welcome back. In this video, we are talking about the AMC earnings, issuing dividend, Citadel leaving, and much more in this video. First, we're taking a look at this. AMC Q3 earnings at a glance. So revenue, we have 1.3 billion versus the 1.23 billion estimated. Adjusted EBITDA, we have 122.2 million versus the 96.2. Now for the EPS, we have negative 0.21 versus the negative 0.19. And so all in all, what we're looking at is how AMC has done well. Once again, when you take a look at the revenue, which is an important fact, especially with what we're about to talk about next, I think it's obviously a very good thing. If we take a look at the detailed look how AMC is doing, once again, there are some factors that you need to understand here. And this is a detailed look. So first, we just talked about how AMC beat estimates. But if you look at it in comparison of previous results, you can see revenues 1.3 billion compared to the 1.348 billion for Q3 of 2024. So there's obviously already a disparity there, but that's nothing of major. We've talked about this already. AMC has put themselves in a position where even if their revenue doesn't beat their previous revenue, they are actually still able to make more off of that. And so a 50 million obviously isn't something that is too big. Now, and again, it sounds like a crazy thing to say 50 million isn't too much, but when you factor in how well AMC is doing, this is something that I think is not too major. Now, the big thing about here, and the thing that I want to talk about most, is the net loss. So their net loss was 298.2 million compared to a net loss of 20.7 million for Q3 of 2024. Now, this is obviously a big difference, but the reason for this is that the increased net loss stems primarily from non-cash charges associated with a transformative July 2025 refinancing that was highly beneficial for AMC, and which allowed AMC to fully redeem all of its 2026 debt maturities. And so this was the big thing. So the net loss is obviously massive, and we're not going to lie and say it's not, because there's a big comparison of 298 million versus 20.7. However, when you understand that the majority of this stems from the fact that it was to restructure and pay off their debt, you understand why that's obviously a good thing and why it was needed. The reason why I say this is because if we take a look at a comparison between AMC and Cinemark Q3 highlights, you can see some of the big difference. Firstly, what we saw was AMC's revenue has actually increased, but what we're looking at is how the difference between how big the revenue is. So Cinemark revenue was down 7%. Now, vice versa, so was AMC as well, but they beat estimate. But it was down to 857.5 million. So already you can see the difference of 1.3 billion versus 857 million. And then net income is down to 49.5. However, what we're looking at is that despite that, you can see how they're able to do certain things. Firstly, retire convertible debt with strong debt reduction, 300 million share buyback program approved, dividend rates 12.5% to $0.09 per share. And so the reason why I want to talk about the comparison is essentially this gives us an indication of where AMC can be as well. Firstly, we have to realize is that AMC's revenue is already bigger than Cinemark's, and that itself, whilst right now may seem insignificant, in the future it will be something big. One of the biggest reasons we know why AMC is not going to profitability is obviously because of debt issues. And with the fact that they are paying off the debt, with the fact that they're going to have a bigger revenue, you can imagine that when it comes to profitability, AMC will be making more, especially with the fact they have more revenue. And then we can also go from there to then obviously understand the potential of share buybacks and of course dividends. Now, the reason why I say this is because recently we've seen with what AMC wants to do with the authorization of shares, and a lot of investors are worried about dilution. But you have to understand is that when in the future AMC is able to put themselves in a position like this, they will also be buying back shares. This is something that we've seen done with other companies. This is something we've known is in the business. And AMC is trying to reach that stage as well. And a big part of that is by allowing them to pay off their current debt. And now another thing is talking about their dividend raising. You can see how Cinemark is doing the same thing. And remember, this is with the fact that their revenue isn't anywhere near AMC's revenue. Now, there are, of course, fundamental differences, something that we have always talked about. And so this isn't to say that, it is all the same. But then it's about understanding the potential in which AMC will have when we get to that stage. Meaning, if AMC was in the same position as Cinemark right now, they will obviously make more because they have a higher revenue. And now it does take a long time to obviously get there. It does take effort to get there. And that's what AMC is doing, is why we've talked about how they're obviously trying to solve the issues to then put themselves at that position. Another big thing is that right now, recently, as we're seeing how the market is extremely volatile, as we're seeing collaterals fail, as we're seeing liquidity drying up, we're also looking at multiple high-level executives abruptly leaving Ken Griffin's Citadel. And so this seems like something that is foreshadowing something in terms of the fact that right now, for a company that's supposed to be the most profitable hedge fund in the world, that's breaking records, why are they seeing executives leaving? And when we talk about some of the previous problems, some of the previous situations we brought up in terms of the fact that collaterals are failing, in terms of the fact Citadel was forced to close positions, some of their pods was losing money, we've got liquidity drying up, and a lot more things, we're suddenly seeing these executives leave. And so this, to me, just seems like that something is about to happen. And especially for Citadel, who have overexposed themselves with multiple positions, we could be looking at a massive collapse. And so that's why we are obviously focusing on this. But it really just showcases that the market is not, the Mary is showing right now. It's not the public image of it's going well, everyone's making money, but actually it's showing how it's extremely dangerous, how there are collaterals just vaporizing. And you can even see that during times like this, there is, of course, the government shutdown, but we're also seeing how the SEC hasn't released the October fails to deliver data yet. And the reason why I talked about this right after what we talked about with Citadel is because it obviously affects firms like this. You have to understand that one of the biggest reasons for why we see FTDs is because firms like Citadel abuses it to make money for themselves. And so if we're seeing something happen, and in terms of something happen with Citadel, and then we're seeing something happen with FTDs, it inclines us to believe that something that they've always done is obviously has gone wrong. Now, this isn't the first time where we've seen a late issuance of the data, but every time there has been something that has been delayed, it clearly shows what the retail has always been right about and what the shorts were hiding. Now, another thing to be looking at is, again, when you talk about FTDs, you can see GMEU has been placed back on the red show after large persistence fails to deliver. So as we're seeing GME, another ETF of GME going to the red show threshold list, you start to see the patterns that are happening. Once again, we're talking about GMEU, an ETF of GME going on the threshold list. And then we're talking about how they failed to release the FTDs. And then we're seeing people leaving Citadel. It really just starts adding up. And then on top of that, when you take a look at the reverse repo, we're seeing how it's extremely volatile. We saw it jump from 2 billion all the way to 24 billion. And now we're seeing that halved down to 12.7 billion. And so this is showing us a big thing. For those of you who don't know, reverse repo is the liquidity that is injected and allowing these banks and institutions to tap into. And it gives us a lot of indications of what's happening, because as we're seeing the liquidity going down, or as we see the reverse repo going down, what we can understand from that is that institutions are failing to get the liquidity that they once had easy access to. But if we ever see a massive injection of liquidity, it then shows that there is a demand for liquidity. Now, a demand for liquidity is not a good thing, because it's saying that certain institutions do not have the money and they are in need. And so when we see the reverse repo go up, that's us understand that these institutions are in need of money. And then once again, when it goes back to zero, or when it goes down to zero, we're going to be realizing that these shorts will no longer have access to money. And that's, it's a very, very crucial thing for us, because it gives us the understanding of where shorts are with their positions, how they're doing, are they struggling, are they in need of capital? Because when they are in need of capital, it means that we are pressuring them. It means that we are putting them in a position where they need need people's help. And that's what we've always talked about with how all of these money in which they've injected, allowing these shorts to borrow, they will all be transferred when they have to cover the AMC shorts to the apes, and that's how powerful we will be. Now, as always known, this is financial advice, so do take class to go and solve. Make sure you do your own due diligence and research, and I'll catch you guys next time.